Now, everything on this list of 7 distributor management topics has a common theme: cash. The old expression, cash is king, has never been more obvious to distributors than those who used up their credit lines during the past economic cycle. When disaster struck, such as a large credit loss or an emergency capital expenditure, lenders had forced the owners of some distributors to put personal funds into their companies or face having their loans called. To a business, cash is oxygen. You don't think about it until you don't have enough. Hope is not a sound cash management practice. Unfortunately, you can't call up your friendly banker in the morning and get a nice big loan that afternoon. The good business practice for cash management is to use cash flow projections. Frankly, to do the things that you would have to do if you were actually in trouble. Like driving your car on the highway, it's far better to avoid an accident if you can. Most wholesale distributors, including lubricants distributors, will look back on the first decade of the 21st century with mixed emotions. As our new millennium dawned and distributors woke up with their ERP systems intact after that much overblown Y2K panic, another bubble burst, the tech bubble, and suddenly stock prices went into the toilet. Business managers became very cautious, but soon the overheated business growth, which had only paused, began to regroup and regain its steam. But then came 9/11. Business leaders panicked again, driving demand downward and setting the stage for 3 long and dreadful years for most distributors, 2002 through 2004. But then along came 2005, 6, 7, and 8. As Shakespeare's character Cleopatra famously said, the middle of the last decade was the salad days for distributors of almost anything, including lubricants. The pent-up demand exploded, and business seemed almost too good to be true. But as the old saying goes, something that's too good to be true probably is. Now, naturally, periods of strong demand have happened before, but the salad days of the mid-2000s had a special twist. This practice, however, changed radically in October 2008. Many distributors saw growth slowing during 2008, and most thought this was just a temporary blip on the growth trajectory that had started into late 2004. But by the time the financial crisis was in full swing following the Lehman Brothers fiasco, bankers were fighting for their own lives. Distributors found that their formerly friendly lenders were unwilling to waive covenant violations. To the contrary, most borrowers were forced to accept dramatic interest rate increases, reductions in borrowing capacity, harsh changes in the terms, and onerous fees to avoid having their funding cut off completely. We prefer to measure current results against actual results for the same period from a year ago, but I really get excited about comparing the results of the most recent 12-month period against the results for the 12-month period that ended 1 year ago. I need to convince each of you of the value of using trailing 12-month results. Year-to-date results, folks, are not meaningful during the first few months of a fiscal year. Most distribution businesses are seasonal in nature. Now, the 2 largest assets for most wholesale distributors are accounts receivables and inventories. In most lines of trade, except for ones like yours which require a somewhat heavier investment in equipment, receivables and inventories make up 80% or more of total assets. First, a comment about receivables. Sometimes we say that credit management in wholesale distribution is the amateur hour. But your credit manager may be the most important decision maker in your company. Why is this? The biggest reason distributors fail financially is credit losses, not losing customers. The person in your company who makes the credit decision stands between your company and potential financial disaster, such as a huge credit loss from the bankruptcy of a large customer, and often that customer is past due and over the credit limit. Unfortunately, though, too many distributors do not put strong enough people in their credit function. The credit department is under a lot of pressure from salespeople, from sales managers, and even from top management, pressure to extend credit to risky customers. If your credit function at your company is weak, you know who you are. Next, a word or two about inventories. Commodity prices have obviously been volatile during this business cycle. No one knows that better than people in your business. Many of you have had major inventory losses during the last 12 months. However, you are not alone. Electrical distributors are struggling with copper prices. Metal service centers are battling steel prices. Packaging distributors are terrified about resin prices. The violent price fluctuations, coupled with a sudden drop-off in demand, especially since October 2008, I keep going back to that, have created a serious bullwhip effect. The bullwhip effect on inventories occurs when inventories are being replenished based on recent sales demand and vendor lead time as determined by your computer system. Distributors who were not vigilant enough continue to allow their computer systems to tell their buyers how much inventory to buy. This automatic replenishment method is especially dangerous if demand levels, vendor lead times, and safety stock levels are not kept up to date. We always suggest that our clients get to know people at their bank well beyond the calling officer who services your account. The calling officer is really a sales representative for the bank. You should try to get to know the decision makers at the bank, whether that's a committee or an individual. Those people probably do not know enough about your business based just on what they see on paper. To have a good feel for you and your company and the way you manage it, they need to learn about the importance of your relationship with ExxonMobil, about your customer segments such as PVL, CVL, and industrial, and what drives your sales and profitability. Uninformed people may think that compared to other industries like manufacturing or banking, that wholesale distribution is a simple business. Buy low, sell high, collect fast, pay slow. Are we really in a simple business? The answer, of course, is no. Distribution is actually a people-intensive business. 1/3 of our people are in customer-facing sales and sales support positions. Our business is a game of inches with very little margin for error. We operate with razor-thin gross margins. A return on sales of 1 to 3% is typical, but the rewards can be great. In terms of return on investment, an outstanding management team in distribution can generate a pre-tax return on investment of 20% or more. Some distribution businesses do this consistently. Unfortunately, though, most do not. The typical company does pretty well at the top of the economic cycle, but struggles to make a profit during leaner times. And at the bottom of the cycle, the very existence of mediocre performers is threatened.